Okay, I'm going to go ahead and get started. I'm going to start with kind of a personal story, because how many of you put together a vision board when you first got started in real estate? I think we all did, right? And they encouraged us at the time to put things on there that seemed out of reach. You know, think big, dream big, think about things you may never, some things on there need to be just so out there that you don't know if you'll ever actually achieve them. And so this was my vision board. And one of the first things I did is I made my husband take 2-step lessons when we moved here. That was an easy one. That was like, okay, I know I'm going to get that one done. The second thing we did is we went to Lake Tahoe, and we spent 3 weeks in Lake Tahoe for our anniversary. Now, that took a couple years, but one thing that's on there that I never, ever thought we would be able to achieve, and my husband's a pilot. He's been a pilot for 20 years. He could fly before he could drive. So our first date was in an airplane, like a little Cessna, that putzed around. And we had flown Cessnas for years and years and years, and cars on the highway are passing you faster than you're going in this airplane. And so one of the things on our vision board was, I don't think the laser works, was that the airplane in the top left, there's a business jet, which is way out there, but the one below it's still like a single engine, seats 6 people, and after 9 years of investing in real estate, we have finally been able to afford that airplane, and we just bought it a few months ago. So this is literally something I thought was going to be unachievable. You put it on the vision board, and you're like, I don't know how it's going to happen. I don't know if it's ever going to happen. But it's an example of if it doesn't matter when you start, but it does take time. I was talking to Ian before class, and we both agreed this is not a get-rich-quick kind of business, but it's a get-rich-for-sure kind of business, because these assets continue to increase in value, whether it's through the market, whether it's through forced appreciation, which I'll talk about. And so this is just an example of, I encourage you to go back to that vision board and think about what could what's on there that you don't think you could ever achieve, but maybe 10 years from now, it's going to happen. And partially because of real estate investing. So whether it's multifamily, which we'll talk about today, whether it's single family, industrial, commercial, I encourage you to, especially now as we're in an inflationary market, put your money in real estate, because it's, from all the economists I've heard, it's one of the safest vehicles to continue to increase in value. So I'm going to give a quick introduction. My name's Emily Cortright. I've been with the office for over 9 years, on ALC for 5 years, and leading culture committee since 2017. I started with single family flips and rentals when I first got into real estate. That was my focus from 2013 all the way through about 2017, 2018. The single family rentals and the flips were great, but it wasn't bringing up enough income to allow my husband to quit his job. And that was always our goal, was for my husband to join me full time. We wanted to both be self-employed, both be in real estate full time. So in 2017, we kind of looked for different avenues. We went to a training class on multifamily investing, and we knew from that point, that's where we wanted to take our business. We did an education program and a coaching and mentoring program, which I relate to MAPS coaching. So real estate agents, KW agents use MAPS coaching to accelerate their business. We used a multifamily coaching program to accelerate our education and our learning. So within the first year, we had a 180 unit in Arlington, a $15 million property that we put together and syndicated after joining that program. Fast forward, today we're on number 8. So I'll show a map of where they all are, but primarily in DFW. And then kind of going backwards, my husband and I are both engineers by trade. We love numbers, we love spreadsheets. We had a lot manufacturing and operations backgrounds in the aviation industry, which is why we love airplanes. But we had that corporate project management leadership background, which relates really well to the multifamily business, because multifamily is very, very much a more sophisticated and complex type of real estate investing as opposed to just like being a landlord for a single family. Oh, one thing, I'm also a passive investor. So we're going to talk about passive investing in real estate, in multifamily specifically. I am a passive investor, me and my husband, in 14 other deals. So these are properties we've put money in. It's been a way for us to diversify our portfolio because we're investing passively in Texas and Florida and Atlanta and Phoenix, Colorado. So we're able to, as you kind of build relationships and meet people, there's opportunities in different markets and to use that as a diversification. This is another share. This is a really exciting thing, but kind of the message of if I can do it, you can do it. Over the past 9 years, our real estate investing has allowed us to increase our net worth by 10x. So this is, and obviously the past 10 years have been a great real estate market in DFW, but the message is that this can be you too. That I'm not special, you can invest in real estate over the next 10 years. I bet you'd get close to that. So achievable for everybody in the room. And this is a wealth building class, so I want to take a few minutes to talk about net worth because I want this to be you when you talk about your net worth. So how many of you track your income and expenses every month? Okay, that's awesome. How many of you track your assets and liabilities every month? Okay, and how many of you know your net worth? Awesome, that's great. So over 50% of the room knows their net worth. For everybody else, everybody who signs a sign-in sheet, I'm going to send you a template to track your net worth. And it's basically going to list out assets and liabilities. It's a very, very simple Excel spreadsheet. And there are online options too. You can use mint.com, which I really like, which is a free service. But if just the absolute basics, if you're not tracking and knowing your net worth, I would encourage you to know that because seeing that number and then once you start investing, watching it grow, every month we do our financials and you get down to that bottom line, that net worth, and you just want to cheers your spouse. You're like, woohoo! So it's a really exciting thing to start tracking and being able to know month by month where that number is going, where if your investments are growing, if they're cash flowing, everything like that. So I want this to be everybody in this room when they look at their net worth numbers. So today we're going to talk specifically about multifamily passive investing. And multifamily is a team sport, so I have to give a shout out to my partners. It's me and my husband, Adam, and our business partners, Bonnie and Carrie. So the four of us are what we call deal sponsors or asset managers. And it's our full-time job, the four of us, to run these properties, to implement the business plan, to work with the lenders, to do the distributions. We'll talk about roles and responsibilities in a second, but I just want to introduce them because I might say I a lot, but in multifamily, it is absolutely a team sport. So when I say us or we as deal sponsors, I mean me and my husband and our partners, Bonnie and Carrie, because without them, we're leveraging each other to manage these large apartment complex communities. Overall, we have about $350 million in assets currently under management, and those are located primarily in DFW. We have 3 in Houston and 1 in Oklahoma. So overall, our main focus is DFW. That's where we love to buy, but we do have another partner in Houston that manages those deals, and Lawton was dropped in our lap. Not something we would have usually invested in, but it's been a great property so far.
Emily, what do you mean by full cycle?
Great question. Full cycle means that we have bought it, we've implemented our business plan, and we've sold it.
Okay, so it's
So
like a closed process.
Yep, we've closed on it, we no longer own it, and we've given back full returns to our passive investors.
What's the timeline on that? How many years do you usually?
So we say 5 years, but all of them have sold before that. And the average is 3 years. The average return has been a 2x, so essentially like a double your money. Now, Past performance doesn't always guarantee future performance. The market has been very, very strong the past few years. So, but the point being, if we can sell early and we can double your money after 3 years or 4 years, we will. And we'll exit, we'll give everybody their money back, and we'll move on and buy another one.
So your plan is kind of quick exit versus long term?
Quick in terms of 5 years or less, yes. Now, let's say if another 2008 happened and we had to hold it for an extra year or two until those market values rebounded, we would. Dustin mentioned yesterday in the sales meeting, even during the 2008 housing market crash, DFW real estate only lost 1% of value. So even in like the worst market crash in my lifetime, the real estate did amazingly well in DFW. So I don't really see another housing market crash like 2008 coming. But the point is, if we had to hold it, and let's say today may not be a right time to sell, but 6 months from now may be a better time to sell. We're always reevaluating that.
We're always going to need rentals, right? Even in an 08. So if a bad market comes, it's going to be almost better to be with somebody like you, right? Am I thinking, because...
Yeah, in 2008, when people lost their houses due to foreclosure, they had to rent. So it did actually, the apartment housing market in 2008 did not have like too bad of an issue, because everybody who got into foreclosure and lost their house had to then go into the apartments.
It wasn't the same issue.
No, it's a very...
Compared to residential,
right.
where the issue was at was totally different.
Right, yep.
You probably blossomed.
Yes. So these are just some of the headlines. These are all from the last month, talking about how tight, how amazing and competitive the DFW market has been for apartment complexes. You've seen it in the single-family world. Now, just like in single-family, the past few weeks, we've seen a little bit of a shift, just a little bit, but it is still it's still crazy out there. We're still seeing multiple offers on apartment complexes. Companies are still bringing their money into DFW. So when we talk about returns, 2 years ago when I did this class, our cash flow expectations from the passive investors were about 8%. Today they're closer to 6% cash flow, still with a double your money, but the cash flows have compressed a little bit because of the increased competition. And you've probably seen that if you have an investor client that wants to buy a rental property, a single family rental, and they want a cash flow at 10%, you pretty much go back to them and say that's not possible. Like, I can't help you find that in today's market. It's a little bit similar to the multifamily market. Our investors that used to expect 8%, we're now having to coach them and reset expectations down to 6%, because that's what we're competing against. That's what the other buyers in the market can pay a price to give their investors 6%. So we'll talk what that looks like in a future slide. So, but just trying to kind of relate the multifamily market to the single family market in terms of the competition, and there's still a lot of buyers from California and hedge funds and things like that we compete with. So one term that I want to talk about is syndication. And I want this term to not be scary, because a syndication is very simply a group of people that pool their money together to afford a property. So if we have a $10 million apartment complex, let's just say I'm going to get a 70% loan. I'm going to need to bring $3 million for the down payment. Well, I don't have $3 million to bring for that down payment. So I raise it from other investors, from passive investors. That, in its simplest form, is a syndication. We have syndicated that apartment complex because we have a group of people that have come together to raise money for that down payment. So I just want to make sure that syndication, because if I use that term, it's not scary. It's a very, very simple concept of people pulling their money together to afford a property. So what does the structure look like? And this is where I mentioned some of the roles and responsibilities. I'm going to start on the right side. The deal sponsors, the lead investors, that's me, my husband, and our partners, Bonnie and Carrie. We do, I'll say, everything. Asset management after purchase, we're working with the lenders, we're doing lender distributions, investor communications, we're analyzing the market when it's ready to sell, we're implementing the CapEx projects. So we're installing playgrounds and dog parks and package lockers and all the other things that happen with the business plan. The passive investors get to do nothing. They get to sit back and watch the reports come through, and after the first 6 months, we start the cash flow distributions.
If we sit there and vote.
Yep. I would say it's mailbox money, but it comes to your inbox. It's inbox money because we do all ACH. We don't do any paper checks anymore because they would get lost in the mail. So when it comes to ownership percentages, it's going to vary by property, but the ownership percentage of the deal sponsors is usually 10 to 30%. And again, this varies by every property. And then the ownership percentage of the passive investors is 70 to 90. So it could be an 80-20, it could be a 70-30, 75-25. If you're looking at a property to consider investing in, it will specifically say what the ownership split is. And I just wanted one more point. The number of, you'll see in a future example, I'm going to give example of properties we bought. The number of passive investors can get pretty high. There's properties that we have as little as 50 to 75 people. There's properties where we have 180 people. So it's not a small group of 5 to 10 investors. This is a large group of people that come together. We have a professional investor management system. So you get a secure portal, you get a login, a password. We're not sending any documents with social security numbers over email. All of those tax forms, you would log into your portal, and they're securely stored on there, as well as all the financial reports and quarterly updates and all the documents you signed, everything like that. So we have an investor management system to help us manage all of the passive investors.
So, Leon, just curious, and I don't know if you can answer this. So let's simple math. Let's say your minimum investment for a passive investor is $100,000. Would you say the majority of those passive investors do the 100, or are there a large number that do a lot more than?
Great question. So he asked about the minimum investment and the average investment. I would say it is around the average. Whatever the minimum is tends to be the average. I think people kind of just gravitate towards that number. We do have people that put in more, and then we do make exceptions for people that need to put in a little less. So you'll see an example from one of my case study slides where it's right about that minimum investment per person. So just a quick overview of the multifamily classes. Class A is your luxury, brand new builds. I would say built 2010 or newer. Class B is built in the late 80s, 90s, early 2000s. C, built in the 60s and 70s. And then D, I would say do not invest. We're not looking at those, so don't even worry about it. We focus primarily on Class B and C. And actually today, we're really focusing more on the B class because the C class tends to have a little bit less favorable mechanicals. You've got aluminum wiring in them. You've got cast iron or galvanized steel sewer pipes that are nearing their end of life. And buying a B-class property with PVC sewer pipes, copper wiring, it's just it's a couple less things to worry about in terms of maintenance costs and potential, long-term hold. So if we had a great B property that was just doing great and cash flowing and we refied out and wanted to keep it a few more years, I would be much more comfortable doing that on a B class than a C class. Because at C class, you're more like, I don't know if I want to be holding the hot potato when all the sewer lines start to crumble kind of thing. So the B class, there might be an argument to hold it a few more years longer because the mechanicals are just so much more solid. So let's talk about some of the benefits. The first is leverage. how many people are familiar with the OPM acronym? What's it stand for? Other people's money. So this is a win-win for everybody because the deal sponsors and the passive investors are leveraging other people's money to be able to afford a 200-unit apartment complex. You can't buy it on your own. I can't buy it on my own. We need each other. We need to leverage each other's money to be able to get into these types of properties. What about OPT? Other people's time. Yes, and that is, you are leveraging me and my partner's time in terms of that. My full-time job is deal analysis, working with the lenders, equity raising. My husband's full-time job is working with the property managers, weekly calls, implementing the CapEx projects. If you probably, as you are running your own business, don't necessarily have the time to do that. So you're leveraging our time, we're leveraging the passive investors' money, and that makes it a win-win for both sides. The cash flow and capital gains, I'm going to go over a specific and show the numbers on this, but overall our minimum return, so I'm acquisitions, I'm out there looking for new properties, I'm doing analysis, I'm touring properties. The absolute minimum that I look for is a 6% cash flow, which I mentioned has decreased over the past few years. It used to be 8. Before that, it was 10. But 6% cash flow and a 70% total return in 5 years. Now, again, I'm going to show an example of what this looks like, but a 70% total return, let's use the example of a $100,000 investment. 70% total return means that you would have $170,000 at the end of the life cycle of the deal. So that includes your return, your initial 100 that we've returned to you, plus 70 of profit. That is a 70% total return.
Does the profit include the cash flow?
It does, yeah. So that could be like 20,000 of cash flow and then 50,000 of profit from the sale, for example.
Is there, multifamily, is there any other type of tax benefit? I know you're going to be holding it. Well,
Yeah.
I don't know how.
So we will talk about taxes on my next point. So there are tax benefits. Multifamily throws off a large amount of depreciation that first year, and because it's written into the tax code that we are allowed to front end some of that depreciation. Basically what we do is we have an engineer come out, and the engineer itemizes all of the 5-year property, the 7-year property, the 12-year 15-year property, and we're able to take all of that 5 to 15-year property in the first year. What that means is like a $10 million property, our first year write-off is usually about 30%, $3 million. And so we have a $3 million depreciation loss. We have a paper loss. It does not mean the property has lost $3 million. It's a depreciation, but that $3 million gets split up between the passive investors. And the example that we've seen really work out average-wise, somebody who invested $100,000 would have a negative $75,000 K1 that first year. Yeah, it's huge. Now, that is considered passive loss. A passive loss can always offset a passive income. So I'll give an example from my personal portfolio. We sold 3 rental properties in 2018, single-family rentals. That was considered, the profits on those was considered passive income. Well, the multifamily that I invested in that same year that threw off a whole bunch of depreciation was able to offset that passive income, and we ended up not having to pay any taxes on the gains from the sales of our single-family rentals. Now, talk to your CPA, because I'm not a CPA, but there could be a scenario where your passive losses can offset your regular income. You'd have to meet certain real estate professional status, things like that, so talk to your CPA about that. But if you can't use the losses, let's say you don't have any other passive income to offset, they will roll forward until the property sells, and then you will then use those losses against the gains when the property sells.
Doesn't it come back when you sell, like with single family?
So there is some depreciation recapture at the sale. And so what we've done personally to offset that, because there is a gain in that when the property sells in that tax year, you'll have a gain on your K1. And we reinvest the money in another deal to have more losses to offset, and we just continue that cycle. So we also, one thing, the kind of the touchy-feely part of it is we're improving the communities. We want to make sure that because we're going to talk about examples where we're increasing the rents, we're increasing the charges to the tenants, we're increasing the amenities, but at the same time, we want to make sure that we bring the value to the tenants. So we make sure our property managers do one tenant event per month. We make sure that there is like a great relationship, that people want to live at the property. We try to focus on, Google reviews, kind of doing incentives and raffles, like, hey, leave us a review and we'll put you in a raffle for a TV kind of thing. So we're going to talk a lot about making money, and it does rely heavily on improving the income at the properties, but we also take the approach to improve the community and make sure that they're getting that touchy-feely, they feel loved kind of thing.
Which is why you can sell it for more later on, too.
Yeah, absolutely. And it's, we'll talk about the financials here in a second. So again, the power of syndication is another benefit. It allows us to diversify across other, we started with only single family, and then it allowed us to diversify into multifamily. It's allowed us to diversify to multiple markets. Even though DFW is our primary market, it doesn't mean I'll never have an opportunity to invest in Houston or San Antonio or Austin, for example. Economies of scale, we use third-party property management, professional property management. So the average 200-unit apartment complex has 2 full-time leasing and 2 full-time maintenance people. They are not calling me to replace their toilets. I'm not processing the evictions. I'm not collecting the rents. We have a full-time professional third-party property manager that does this for us, and we manage the property manager. There's also,
Are they on site then? Or?
Yes. So the 2 full-time leasing and 2 full-time maintenance, for example, are on site all day, every day, like 9 to 5.
Did you always have it that way, or when you first started, did you actually get more involved in the operations? Or not?
It's always been that way. Yeah. We actually bought our very first property. We bought from a couple who self-managed 180 units. They were there every day, full-time job. And so it's kind of it's the leverage mentality, where my time as a business owner is not best spent collecting rents, filing evictions, handling maintenance requests. Like, we hire that out to people that's what they focus on. And then with multifamily, there's a lot of units, there's a lot of income coming in every month. We have a tolerance for HVACs and hot water heaters and the maintenance requests that do come up. With single family, my AC went out, it cost me $3,000, $4,000 to replace, and there went my cash flow for the whole year. Like, I literally spent my cash flow. Multifamily has a lot more, there's so much more income, so many more units in terms of economies of scale, that we can just afford and absorb those costs a lot easier. When we do our due diligence, our inspections, they go through and they test every single HVAC unit, and every single hot water unit gets looked at. So we have a list of all the AC units that need replaced like today, and all the hot water heaters that need replaced today, and we just budget it. Like, let's just do it. So the economies of scale is pretty powerful with multifamily. And then financing, this is a really interesting one that I didn't realize at first. So when I bought my fourplex, we bought it under our own personal names, and this was back in 2013, got a great 30-year fixed-rate mortgage on it. Well, we went to go buy a personal house like 6 months later, and the first lender we went to denied us and said, nope, you can't buy your house because you have this fourplex on your credit that is thrown off your debt to income kind of thing, because we were only on one income. With this, in multifamily, it's a whole different world. We have what's called non-recourse loans. And that means that We have a loan for $47 million on the last property we did, and that doesn't show up on my credit. I'm signing a loan for a $28 million loan in another few weeks. That's not going to show up on my credit. These loans, the only recourse that the bank has is to take back the property. They can't come after my personal bank account or any of our passive investors' personal accounts. So the only collateral that they have is the actual property, which is super powerful because it's like, I had trouble buying my single family house after one fourplex purchase, and now we have probably over 100 million in loans that I've signed on, and that doesn't show up on my credit report.
Do you only use one lender, or do you use different lenders?
We use different lenders. The question was about lenders and who do we use. We've had properties where we've used Fannie Mae, we've used Freddie Mac on others, we've used a bank on others, and we've used bridge, like short-term bridge loans on others. It really depends on the business plan, the location, and the state of the market. Like right now, Fannie and Freddie don't have attractive loan products for multifamily. Now, they did a couple years ago, and they probably will in another year from now, but right now, it's just, I can't get the numbers to work with a Fannie or Freddie loan. So it's very property specific, but yeah, we have loan experience with all the different types. Did you have a question?
Yeah, do you use separate LLCs then for each?
We do. Every single property we buy is bought under its own LLC. And then the passive investors buy shares or own shares of that LLC that owns the property. So none of them are, there's no like commingling of bank accounts. Everything has its own separate entity, separate bank accounts. And that way when we sell one, we just close down that entity, and then all the others are still there.
So we give it in our own name, or if we have a personal LLC, it just reports to that.
Yep. And we'll talk about that. I think that's
Do a lot
on.
of passive investors have LLCs? Or-
You know, I would say it's probably about 60% individual investors, 30% entities, trusts, and LLCs, and then maybe only 10% IRAs.
So you can use a self-directed
Mhm.
IRA and invest.
Yep.
Why wouldn't people do that more? I mean, can you get the can you take advantage of the depreciation?
So,
Use the IRA?
great question. The reason that the downside of using a self-directed IRA is that you typically cannot use the depreciation. So it just doesn't flow through to your personal tax return, and then there could be, the gains could be subject to UBIT taxes after the sale. So, but you wouldn't have to worry about that till after the property has gone full cycle, completely sold. But yeah, those are the two biggest downsides.
But if you use an LLC, you can still take advantage of the depreciation personally?
You should be able to, because your LLC should give you a K-1 that would then, as long as it's a pass-through. If it's a C Corp, it might be a little bit different because the taxes are paid within the LLC, but any kind of pass-through LLC, that depreciation losses should flow through to your personal tax return.
Seems like that's the smartest way to do it. You have the protection of the LLC.
Mhm.
So take advantage of it.
Yeah, I mean, my husband and I, we still invest under our personal names because there's so many protections built in already above.
If you buy, let's say,
Mhm.
it buys under its own, then that's who they would go after first.
Yeah.
versus trying to-
Yep. So, and we'll talk about that here in a second. First I want to go over just some quick numbers. And I know sometimes people kind of glaze over when we talk math, but this is important because this is how the properties increase in value in such a short amount of time. So single family, we all know, is valued by comps. You run a comp, the house next door sold for this. Well, in most markets, the past 6 months have been a little different. But multifamily is valued differently. Multifamily is valued based on the net operating income, or NOI. And basically the net operating income is your income minus your expenses. So if I have two apartment complexes right next to each other, but one of them's had all the interior units upgraded and has better amenities and they charge more and they make more, this one will be worth more than the one next door. Just point blank, they're valued based on NOI, net operating income. So how do we know what that value is? Well, it's based on the cap rate. So the NOI divided by the cap rate gives you your property value. And we'll see an example of this. But if I increase my NOI, I increase my property value. And this, it's kind of a simple concept, but this is how we can improve or increase these property values in 2 to 3 years and be able to exit. So let's just say that through, I'm updating the units, I'm doing some expense reductions in terms of low-flow toilets and LED lights, and I increase my NOI from $600,000 to $720,000 over, say, 2 to 3 years. If the cap rate remains the same, I have increased the value of my property by $2.4 million, from $12 million to $14.4 million in just that short amount of time. Now this assumes the cap rate has stayed the same. If the cap rate goes down, the property value has gone up even more. So this is just an example of how the multifamily properties can increase in value in such a short amount of time. So basically we implement our business plan and we check to see if we can can we exit? Can we make people 70 to 80% total return after 2 to 3 years? And if the answer is yes, we'll usually sell and everybody's happy.
How do you decrease the cap rate?
So the cap rate is determined by the market.
Okay.
And it's determined by how many investors are investing, like what people are willing to pay for properties and what returns they're willing to get.
What will be an average, 5 or 6%?
You know, today we're seeing closer to 4.
So that's good.
It is good, yeah. So it's, and then me being the analysis, the acquisitions person, even if we're buying at a 4, in my spreadsheet, in 5 years from now, I'm always projecting the cap rate to go up. So we're actually having to increase the income even more to offset that increase in cap rate in my spreadsheet. So I always just want to be conservative and say that the cap rate's going to go up, just in case.
You're a hero.
Yeah, if it stays flat or if it goes down, which is what's happened essentially the past few years, the cap rates have continued to compress. And we've been able to sell, even if we haven't implemented our full income business plan, the lowering cap rate has allowed us to sell and double people's money and get out early. So what kind of properties specifically are we looking for? B and C class properties, they're called low-rise, garden style, 2 or 3 floors. And you don't see a lot of like 4 or 5 story, but once you get into 4 story, you have to have an elevator. So just a little bit more maintenance costs, but you just don't typically see that in the DFW market. We're looking for stabilized properties, 90% or higher, and that means we can get better loan products. So if a bank, if somebody has a 70% occupied property, the banks are going to give you a little bit, they're going to be a little bit more hesitant to give you a great loan. So we look for 90% or more occupied. Today, that's not hard to find. All the apartment complexes are pretty much full, 97, 98% occupied.
So when you do your due diligence, do you go back to that property and say, do you have the percentage of occupancy for so many years? Will they have that?
Yes.
And that's
Yep.
how you guys find it?
Yep. So and in the brokers like listing materials, it lists today's occupancy. But yeah, we do see when we get a property under contract the historical occupancy.
Not that we would worry about it, something you worry about. Is there a way for them to lie about their occupancy and vacancy rate?
I've seen that once, not on a property we bought, but we toured a property near downtown Fort Worth, and I had my property management company guy tour it with me. And we were walking around, and he was asking, like, who's the seller on this? And the broker told him who the seller was. And so after the tour, he pulls us aside, and he goes, don't buy this property. And we're like, okay, I'm going to take your word for it. He goes, this seller cooks the books, like, not a good person to buy from. And we obviously passed on the property, but we know who bought it. And found out afterwards, after he bought it, that they had said it was like 92% occupied. And when they did their unit walks, there were a lot more vacant units than what was disclosed. So my goal is to always buy from like high integrity sellers. These are legitimate companies. We ask the brokers every time who the seller is. How many properties do they own? Have you sold a property of theirs before? What's, their track record as a seller? Because unfortunately, there are some sellers that
So you
may.
go back to that previous owner, like in residential real estate with the seller's disclosure, it's like, okay, you didn't disclose this.
So there is no seller disclosure
Well,
in
I'm just saying
multifamily.
sell it,
Right.
something similar to that.
You
Yeah,
could try. I mean, you could try to get out of the contract. At that point, this is all during the contract period where you would find this out.
Okay.
And you would probably just back out at that point.
It sounds a lot like what Elon Musk is going through buying Twitter.
Yeah.
It does.
Yeah. In terms of property size, we're looking for 80 units or more, and really our smallest property is 117 units. Our biggest one is 324. So I would really say that 150 to 350 is our sweet spot. Again, with economies of scale, that allows us to use professional property management, keep it achievable. When you start getting into like 500-600 unit properties, it takes a long time to kind of steer that ship in another direction. So we really like that 150 to 350 number. We're looking in strong markets, strong tenant pools, job growth, population growth, good school districts, landlord-friendly states. I'm not going to buy in California. Basically, I'm really just focused on DFW at this point. And then different deals have different strategies. Some properties that we buy are cash flowing great from day one. Some properties that we buy have more of a value add component, and we have to update 75% of the units. We have to implement all these business plan items. And so the cash flow is going to be specific to each property, whether it's going to be a really strong cash flow from the beginning or maybe start a little bit lower and then tick up as we implement our business plan. So here we're going to get to some FAQs. And the first one we've kind of already talked about. What money can I use? Cash, entities, and entities include LLCs, trusts. We've seen people put together, like I've seen a father-son come together. We've seen 3 business partners come together and form an entity. And that's mostly because sometimes as the minimum investments are higher, and we'll talk about that on the next bullet point, but like 75 or 100,000 for some people might be out of reach, but if they pool their money with business partners or somebody else, that might be more achievable. Self-directed IRAs, we mentioned this before. This is self-direct or solo 401ks we can also do. It can also be a combination. So we have some people that say, oh, I have 50,000 in my self-directed IRA and I have 50,000 of cash. Let me put those in, or 25 and 25, for example. It can also be a combination. The minimum investment varies by property. It's either going to be about 50,000, 75, or 100. And my disclaimer here is if whatever the published minimum is, if you can't do it, don't be afraid to come and ask. The worst case is that we'll say no, not, I can't take that amount this time. Maybe you might have to wait till next time. But if the minimum investment is 75 and you're like, I've got 60 in my IRA, chances are we'll be able to work with you. So don't be afraid to ask. The typical returns, we've talked about this, 6% average annual cash flow and 70% total return. And I'm going to show that in an example. This is one of the most important differences between single family, because the question, is this a liquid investment? And I'm going to say the answer is no. This is money that you are okay setting aside for 5 years, just in case we hold it that long. But this is not money that you need to go buy groceries. It's not money that you need to pay your child's college tuition next year. This is, like, for us, we have a 1-year-old. This is money that is her college tuition years from now. This is money that we're just going to let build over the years. So if we were to refi, you might get your initial investment back pretty soon. But otherwise, 5 years, I would say plan for it to be gone for 5 years, and if we can return it in 3 to 4, then everybody's happy. How often are distributions? So we usually wait till after the first 6 months of operation, so we give the property 6 months to stabilize and really implement our business plan, and then we start monthly distributions. And that is done by ACH, and it's based on the performance of the property. So typically, if the most of the properties are, I would say 4 to 6% year one cash flow, and that'll come in the monthly ACHs direct to your bank account. How does it report to my tax return? We've already mentioned this a little bit. It's a tax form K1, and if you're familiar with if you have any other LLC, the K1 is the form that the LLC produces for you for your personal tax return. So just like if you do an LLC for your real estate business, the property LLC puts out a K1 to all of the passive investors.
And when do those go out? The day before you're supposed to?
Yes.
That's just a joke.
Yes. So if you invest with an entity, you probably won't be able to do your tax return by March 15th because we'll usually take till March 15th to do ours and then get you yours, and then your LLC would then have to do another tax return. So you just know if you invest with an entity, there may be you may have to do another tax return after we give you the K1 for your entity. Do you have to be an accredited investor? And the answer is no. But the IRS says that if you're not accredited, you have to be sophisticated. And I would say that this class, in my book, qualifies you as sophisticated. Sophisticated means you have an understanding of what you're investing in. And basically, even if you're accredited, I want you to understand what you're investing in, period, because that's always important to know what you're investing in and with who. So you do not have to be an accredited investor, but we do have a limit of non-accredited investors, and that's 35 per property. So again, if an opportunity comes out and you're interested, let's start the conversation, let's ask the questions, and go from there.
What's the process to become accredited?
So to become accredited, you have to, as a single person, make $200,000 per year, or as a married couple, make $300,000 per year, or have a net worth of $1 million or more, not including your personal residence. So,
Do you become accredited when you get into one of these?
No, not necessarily. It's because when you fill out the paperwork, it means like today, we haven't closed yet, like, are you accredited? And one question I get asked a lot is like, does a third-party company check my accredited status? And the answer is no. This is a form that you fill out, and it says like, do you make $200,000 as a single person, or $300,000 a year, or have a net worth of $1 million or more? Yes or no. Check or check. Right. It's a self-accreditation. We are not going to collect your bank account statements and verify. So if your net worth is, $999,999, nobody's ever going to know. So, yeah, self-accreditation. And who is notified about an opportunity to invest? Anybody we have a pre-existing relationship with. And so we keep a running log of an investor database. If I haven't met you before today, all we need to do is a quick 15 to 30-minute phone call because I do have to, this is a raise and we follow SEC guidelines. And so I have to get to know you if I haven't met you already and kind of create that pre-existing relationship. Then you'll be notified of any opportunities. And I'll talk about that timeline here in a minute. I think it's next. Oh, not next, but.
So what happens if you don't? What does the SEC do if you don't do that?
Well, it's more about if you get audited. Like, we've never been audited, but if they were to, I'll kind of go to this one. So Cooper Park, we had 56 passive investors. If I got audited, they may go and say, I need to make sure you knew all 56 of those passive investors before you got this property under contract. Yeah. And, do they have enough auditors to do that to everybody? No. But if I'm ever audited,
Basically, they would fine you on
I assume it's a fine. Yeah, they could, potentially, I don't know if they could do anything to like our LLC or anything, but I would assume it's just a fine on our part if we were,
Depends on how aggressive they want to get.
Yeah.
They could fine you, they could just say you won't be able to do anymore.
Yep. So
The real role of this is that it's to protect you from being sued by your investors.
Right. Yeah. Because the last thing I need, of my 56 passive investors, if, when times are good, everybody's happy. And Dustin's used this analogy before. When times are bad, people start to sue. They start to get upset. So we haven't experienced that yet at all, like with the past 8 years of the real estate market. But yeah, if we had another crash, and let's say we had to hold a property for an extra year or two, and we had some angry investor that said, well, you said it was going to be a 5-year hold, and it's been 5 years, and I want my money back. If we didn't have that pre-existing relationship, if he would probably try to find that loophole to say like, well, we didn't have a full pre-existing relationship, you shouldn't have let me in your deal. That's more so like how you get caught when people get unhappy. So
People just don't like to follow rules.
Yeah, but so I have a full meeting log. Like every meeting that I have with people, it's in my meeting log as well, another tab of my investor database. So we keep pretty good records. We're engineers. We love spreadsheets. Like, let's be honest. We have good records. So I'm going to go through a couple case studies. Cooper Park Apartments. This was our first property we bought back in 2018. We had 56 passive investors. We raised $5.6 million. So this is an example, to Joe's point. The minimum investment on this one was actually $75,000, but the average was $100,000. So just to kind of give you a baseline, we purchased it for $15.2 million, sold it for $18.2 million. Everybody made a 35% total return or a 1.35 multiple in 2.5 years. Now this one, looking back, I think we sold it a little bit too early, but we were nervous that COVID 2.0 was going to happen, and we took the mentality of, if I can sell it today and make everybody money, everybody makes money. We're all happy. I don't know what's going to happen next year. And this property in particular was hit pretty hard by COVID. It's in Arlington. It's near the Arlington Highlands, mall area, a lot of retail, a lot of retail restaurant workers. Most of them lost their job during COVID and were really paying rent with stimulus checks. So we sold, everybody made money, everybody was happy. If, look, hindsight 2020, probably should have held it an extra 6 months, 8 months or so. But that you make the best decision at the time with what you have. This property, North Haven Terrace, is a better story. We have held it since 2019. We have 77 passive investors. Bought it for $21 million. It's currently under contract for $34 million. And that's in about 3 years. We'll be giving these returns. So it'll, knock on wood, nothing changes. We're supposed to close in about 3 weeks, but the estimated return should be closer to like 2.5 times. So somebody who invested 100 should make 250. Now, this is an example of, past performance doesn't always guarantee future, but this is.
Invested in that one, isn't it?
Yeah.
I'm very happy.
This has been a great property. And just to give another COVID example, this property is in a very Hispanic neighborhood, and not a lot of the tenants lost their jobs during COVID. There's a lot of construction, a lot of landscaping, a lot of outdoor businesses, and Texas didn't really shut down construction during COVID. People still needed their grass cut, and you didn't have to be around your landscapers in order to do that. So this property fared much, much better during COVID. So it's just an example of how different properties and different demographics can behave differently.
It's interesting, though, I talked to Emily about this. This one, I'll be thrilled with the total return, but on the other hand, the distributions on it were awesome too.
Mm-hmm.
So it was almost like having a passive, to use your words, mailbox money, even though it's
Yeah.
not mailbox money, on a regular basis, and I love that too.
Yeah, this one cash flowed anywhere from like 10 to 12% per year. So yeah, it was kind of one of those things where like, do we want to sell it because it cash flows really well? But I want to be in the position where I'm selling because I want to sell, not because I have to sell. And that's kind of our, if we can double people's money and everybody's happy, I'd much rather have that than like, oh, be greedy, I'm going to hold it another year, and then the bottom falls out, for example.
Would this be a C property or is
This is definitely a C property, yes. And this one has aluminum wiring and flat roofs and cast iron sewer pipes. And so that's another reason we'd rather exit.
a nice playground?
It does. Very nice playground and a nice pool. Here's some examples of some of the improvements that we did at North Haven. So one of the big things, this is an all bills paid property. So we don't charge back the tenants for the water, the electricity. It's just built in. Well, when we toured this property, there was so much water loss happening. Faucets were on, toilets were leaking, shower heads were leaking, and just so much opportunity. We did a full water conservation package. It cost us $110,000 to outfit the entire property. It cut our water bill from $22,000 a month to $11,000 a month. So we literally saved $120,000 a year just from implementing water savings. And that directly increased the value of the property. And that project took about 3 months to implement. We implemented uncovered reserved parking. So how much does it cost to get a stencil and spray paint reserved on the ground? It's a pretty low cost of implementation. And at first we were charging $35 a spot. Now we're charging $50 a spot because parking is tight at North Haven. We put in a stone grill and pergola. We've also since put in a soccer field. The kids love the soccer field. So that goes back to we want to improve the community. We want people to want to live there. And we had the land for it. You can kind of see it back behind the pool in the pergola area. Another thing we did was implement fire extinguishers. This was a lender-required repair. So it wasn't something that was necessarily in our business plan at the beginning, but the lender said, hey, I want you to put fire extinguishers in every unit. And we said, okay, we'll do it. A couple weeks after closing, got it done. A week or two later, a tenant had a fire on her stove, and she was able to put out the fire herself with the brand new fire extinguisher we just put in. So it was whew, that was the best $7,000 I ever spent because fires can be pretty destructive when they start growing through the apartment complexes.
How do you manage the snowstorms, like fire or something like that? What happens there?
So the how do we manage fires? And we've had a fire. We had a fire at Cooper Park while we were selling it. And the property management company knows exactly what to do. They relocate the tenants as quickly as possible to unoccupied units. They help us do all the insurance paperwork. And really, we rely on insurance proceeds to rebuild and remodel those units. Third case study, this is Eagles Point. This is a property we own by Eagle Mountain Lake. It's on Boat Club Road, if you're familiar with that area. This one we bought December of 2020 at $31 million, and it's currently valued around $40 million. This one's cash flowed 6% the first year. But here you start seeing the passive investor count get a little higher. 147 passive investors in this one with a $12 million raise. So that one had a minimum investment of 75, and I would say that'd be right about the average of what people put in.
Do you have to do that because the number's bigger, the 31, or just
the 12 million, what we raised was bigger.
And that's when I wish I would have called you to say, I don't have 75, I've got a little
Right.
less.
Yeah.
I didn't know that.
Right.
Otherwise I would have been in that one right there.
Yeah. That one, and now we're starting to buy nicer assets. That's when we really realize we need to buy in mid 80s or newer assets. So that one's a great one. And then this is just another case study. This is one that we bought in February. We closed in February at $52 million. This one is right off the LBG, the Turnpike in Dallas, kind of between Carrollton and Plano. And we got it under contract in Thanksgiving of last year. I was at my parents' house, Thanksgiving, trying to, you always work escalates when you go on vacation. So, you know, I'm at my parents' house trying to enjoy the holiday, and we get the call like, you got the deal, you got the property. And we're like, woo! Now the hard work starts.
Right.
So at the time, it was $163,000 per unit, and so it's a 320 units. I'm sorry, 320 units, 163,000 a unit, and by the time we closed in February, 4 months later, 3.5 months later, the properties around it were already selling for 210 a unit. Like, that's just an example of how fast the market went up over the past 6 months. So this one even higher, 170 passive investors. This was another $75,000 minimum, just because of the raise. But another 1980s property that we're really excited about. And we are repainting the blue. We're getting rid of that blue. So, yeah, it's a little ugly. You're like, who decided this color? So here's an example of a 6% average. And I want to say average, so it's not necessarily 6, 6, 6, 6, 6. It could be 4% year 1, 5% year 2, 6 year 3, 7, and 8. And that would average to a 6% annual cash flow. So in this example, let's say it was the cash flow was 4% year 1, 5 year 2, 6, 7, then 8. You would have gotten $30,000 back in cash flow. Then the property sells at the end of year 5, and you get back the rest of your $100,000 plus an additional $70,000. So that's what I mean by a 70% total return. You put in 100, you make back 170 at the end of everything, including the cash flow. Yeah, and I'll send out all these slides so you can look at these slides, kind of digest.
Look at that, an average 14% return.
So like,
Yep.
It could be quarterly, it could be.
It's monthly.
Oh, it is monthly.
Yeah, it is
So
monthly.
you're getting $4,000 basically for the 4,000.
Yeah, 4,000 divided by 12.
I see, because if they use it quarterly or.
It could be quarterly, but so the past few properties we've purchased, it's all been monthly distributions. Okay. So timeline of events. This is, you'll see this. I'm just going to summarize. So we do not raise money until we have a property under contract. So we have about a 2-month, 60-day window, 60 to 70-day window from the time we get the property under contract till the time we close. And in those middle 30 days is when we tend to raise equity. So we get it under contract. We do our inspections, our due diligence. We walk all the units. We make sure the seller's not lying about his occupancy numbers. And we get bids for roof repairs. We get bids for hydrojetting the sewer lines, all those kind of things. We make sure we adjust the numbers to, based on any findings. And then we put out the opportunity to our investor database. At that point, we have about 30 days to raise all the funds and get the money in the bank account. Now, some of the raises are smaller and they fill up quickly. Quickly sometimes is a few days to a week. The bigger raises, like Eagles Point, where we raised $13.5 million, or this last one, Retreat, where we raised $13.5 million, took about 3 weeks. So it varies. One of the resources I'm going to send everybody is sample legal documents from a previous property. It's actually going to be from Eagles Point, which we, the Boat Club Road one. So you'll have sample legal documents. If you ever need help sleeping at night, just feel free to start reading them, and then you'll go. But it's just so you have them to review if you'd like to beforehand. Yes.
2 questions.
Yes.
So you're in the feasibility period, it sounds like.
Mm-hmm.
You're doing your capital raise at the same time. So have you lost deals at that point? 2 questions. One, because the deal was bad after your feasibility, you said we're not going to do this. And 2, you can come up with capital from what you were raising.
Okay.
What were the numbers?
Yep. So the question was, have we ever, backed out because of what we found during due diligence, and have we ever not raised the equity? And the answer is no and no, but I want to go into more details on both. So due diligence, there would be an opportunity if we found something very, very significant that we could not absorb the cost of, we could renegotiate with the seller. So we could say, hey, one of our colleagues that I was just with a few nights ago just had to do this. In their paperwork, it said brand new roof. and they got the inspector on there, and the roof was in horrendous condition. So they went back to the sellers, and they got $350,000 credited for roof repairs. So we personally have not had to do that. We try to do as many inspections before we get under contract as possible. And there's even a week or two window from, in commercial, you submit an LOI, a letter of intent. And it's basically a one-pager. It says the price and the high-level terms. And we submit that gets negotiated, the seller agrees, we approve your LOI. Then it goes to the attorneys, and we have another week and a half before we actually have a contract signed. We can get trades out before we even sign the PSA.
And how much does that cost you?
I mean, the roofers are typically free. If we want to do like and it's usually all exterior, right? I can't necessarily go walk the units before I'm under contract, but I can get somebody to go look at the exterior. There was one property we toured. My property management company, again, saves us because they take you on the tour route, which is like all the pretty stuff.
Right.
Well, he walks around the back of the property and he sees a whole bunch of termite damage. And he comes up to us afterwards and he goes, don't buy this property, too much termite damage. So we really rely on that second set of eyes beforehand. And even if we were already, let's say we got the LOI awarded, we could have our property manager walk the exterior, not bugging any tenants, not affecting the operations, but just that second set of eyes. And if something was to be found before we signed the PSA, we could, renegotiate at that point. In terms of not raising the equity, no, hasn't happened yet. We've always been able to raise the funds. And I would say plan B, if we had a property under contract and we were raising equity and for some reason we can't raise enough, we would bring on an additional equity raising partner. So each property, you'll see me and my husband, our partners, and then you'll see one or two other equity raising partners. And they are only there to help raise the $13 million or the $20 million for the down payment. So worst case, if we had to bring on another equity raising partner, that would be plan B.
What do you do? How do you look for an equity raising partner?
We have some in the database. Like, for example, there's a gentleman who owns like 5 hospitals in Houston, and he's worth like $100 million, and he has a huge database. Well, we would give up part of our sponsor compensation to him to help essentially we're paying him to bring investors to the property.
Partner sponsor.
Yeah. So we would split the pie with him from our compensation if we had to bring him on to help raise additional funds.
Okay.
Yeah. So there's always a plan B. Most of these properties have significant earnest money. So the last deal we did had $1 million of earnest money. So I'm gonna figure out a way to raise those funds. But this goes through the whole timeline. I want to wrap it up, so to respect everybody's time. Just a quick summary, multifamily is a great way to diversify. Versus stocks and bonds, the assets are increasing in value with the inflation market. Real estate's going to keep going up as inflation happens. So for me, it's a way to diversify. For the passive investors, it's a way to invest without having to do any work. It's the easiest investment you'll ever make. You digitally sign the paperwork, and then you have no more work.
Now, it seems to be one advantage in investing in a single-family residence over this would be you can leverage the government's money, loan money to then invest. Whereas this, I think, would be harder to get a loan to invest, so to speak.
So potentially, the question was like leveraging money. Well, if you were to buy an Airbnb house today, for example, or let's just say a single-family rental, you may be looking at $300,000 to $350,000 for that single-family rental house, and your down payment might be $75,000 today. So, 5 years ago, you could get a house for $20,000 down payment. Today, that house is now a $75,000 down payment.
Yeah, but that house that's 300 now is still going up in value by 6-10% on the 300, not just on the 70 you had to put down. So
right.
Yeah.
So single family, if I made a lot of money on single family houses. So I can't argue with you. It's a great investment if you have the time and you find the deals, because now, for me, finding the deal was the hardest part. So this is an opportunity to just leverage somebody else that I'm out there finding the multifamily deals. So, but that's a great point. No, it's a.
I'm just thinking it through in comparison to the others.
It's a great point though. Like you could probably make more if you found a great rental property or a great flip property. You can make faster returns, and it would be more liquid. Absolutely. But this is just another opportunity, another option.
This is change your family's future.
Yeah, if there's money you can set aside and just let it grow and let it snowball, and you don't have to do anying, this is what this opportunity is.
So Emily, just to Chris's point,
Mhm.
we have both.
Mhm.
We have single family and multifamily, and I love the multifamily for the reasons Emily's addressed, that I just sit back, I don't do anything.
Right.
On the single family, we have to worry, even though we have a property manager, we have to worry, well, are they gonna get a new tenant right away? And is it gonna be occupied and start bringing that rental income back, right? You've got all the maintenance and everything required for that. So I mean, it's kind of a wash. You just have to figure out what's best for you.
Mhm. Yeah.
A rough single family 4-year timeline with like a 5% increase, and it kind of works out to almost the same, but
Mhm.
to your point, less work.
Yeah. Yep. It's more leverage in terms of, these are higher economies of scale. If we have so many, one tenant leaves in your single family home rental and you have no income, and you're just bleeding cash, whereas here the economies of scale allow it to fluctuate, and the property still performs very well.
What's the name of the guy that I went to that weekend that you're?
Brad Sumrock.
Yeah, Brad Sumrock.
So
Are you still affiliated with?
yes, we are. Mm-hmm.
Yeah.
Yep, and that's my coach. So we have coaches. We still have coaches that review our underwriting before we put in an offer. So I'm still part of that mentoring program.
I went to a 2-day weekend, and we literally toured apartments.
Mhm.
When I left that weekend, it's like, okay, I don't even want to do residential real estate. Here I am, 2 years later, still haven't done anything.
Did you do your first deal as a passive investor?
I did. So question was my first deal a passive investor? It was because it was easier to just invest passively. It took us about a year to get our first deal sponsored deal. And that was putting in offers, losing. And so it was easier to just invest passively in a few other people's deals that already had opportunities. And with my IRA, I can't invest in my own deals anyway. I have to put those in other people's deals. So. Yeah.
Because I went to one of these with somebody else. Being a passive investor, because I know some people say, well, if you want to do one of these on your own, do those doors then count for your portfolio, basically, to help you go to a bank and say, hey, I'm already invested in these many doors, and this property.
Yeah. So the question is, being a passive investor, does that help you buy a multifamily on your own? Not really. You're not on the loan. So none of the passive investors are on the loan. So you don't really have that lending on your resume. You have the experience, the experience of as a limited partner. It's definitely on your resume, but because you're not a signer on the loan, it doesn't really count. If you wanted to buy a 100 unit on your own, it doesn't really help, to be honest.
Good entry level is being a passive investor.
Yeah. So.
Do the passive investors have any input on when to sell, those kinds of decisions?
They could. If it's close, we'll do a vote. If it's in the past, it has not been close. It's been like our prepayment penalty is too high to sell, or our prepayment penalty is really low, so we can sell right now. But our supplemental, like for North Haven, we looked at holding it longer and getting a supplemental, but we were only going to get like $1 million in supplemental loan proceeds, or I can sell it for $34 million. Like, duh, And especially with the age and the mechanicals and everything like that, it's like, I just don't know if I want to hold this property much longer. So if it was close, we would put it out to a vote. But in the past, it's been like one glaring good option, and then like, I don't know if that's, it's not really a second place option. So, We've kind of talked about the rest of this. The DFW market is just on fire, so that's where we're buying. I don't see that slowing down, especially as buyers are getting priced out with interest rates of buying homes. We're seeing just more and more rentals coming in with businesses moving here. The demand is so strong, and the gap between what they pay in rent and what they would pay in a mortgage pity payment is still very, very high. Even though the rents kind of seem high, it's like there's still a $600 gap between what they would pay in a mortgage pity payment. Control, this goes back to the COVID example. Like, all my stocks dropped during COVID. Our properties, we were able to work with the property managers, to work with the tenants. Like, multifamily did great during COVID, and then it accelerated super fast after COVID. So you've got local people here managing these investments. You could drive to the property anytime you wanted to see it. We hold investor appreciation events. So after we bought North Haven, we invited all the investors out to the property. I think it was like 6 or 12 months after we bought it, to show them the improvements that we've done. We want to make sure that you feel involved. And so resources, I'm going to send everybody sample subscription documents, just some video links, and a sample property newsletter. We do have an in-person lunch and learn on July 16th. It's supposed to be at Christina's here in Southlake, but it's not air conditioned, so I'm looking for a new venue right now. It's in the morning, but still, I'm just like so over the heat already. I'm like, we got to find another venue. So, but be on the lookout for that as well, that I'll send out. So
do you have any opportunities on the table right now?
We do. And so for people that I've had a pre-existing relationship with before, we do have one under contract that we just started the equity raise last week. If I haven't met you before and that you're going to be new to my database, you're not eligible for this current opportunity, but we should buy at least one more by the end of the year.
So that should be in my email somewhere.
Yes.
Okay.
Yes.
You look at your email, John.
Too busy calling.
So if I don't know you, if we don't have a relationship yet, the next step is to just let's set up a phone call. Because after that phone call, it can be as short as 15 to 30 minutes. I log it in my meeting log, and then you're in my database from now. And we don't spam your email. We only send emails out once we have a deal, pretty much, an opportunity.
And when you say know you, I mean,
Yeah, like so you and I
met you 9
Yes.
years ago, so I don't
Right.
know how where that stands.
Yeah, so you would be eligible to invest, John, Joe, Juan, but for the ladies and gentlemen that I haven't met before, I would need to do a meeting. And so this is my Calendly, which you can find a time that works for you. And are there any other questions? I know we're about 5 minutes over, but so I want to respect everybody's time. I thank you all for staying till the end.
Thank you very much for the opportunity to listen and learn.
Yes,
Thank
yes.
you for doing this.
Yeah,
Good.
absolutely.